Silver doesn't usually scream for attention. It doesn't dominate headlines like tech stocks or crypto. It doesn't trend on social media every day. And yet, in the background of the global financial system, silver just delivered one of the most brutal and misunderstood price collapses in recent history. A collapse that wiped out tens of thousands of traders overnight. Not because they made bad calls, not because demand disappeared, not because silver suddenly became worthless, but because the rules of the game changed while most of the market was asleep. This is the story of how silver crashed from the $88 zone to the mid-70s almost overnight, how more than 41,000 traders were liquidated in a matter of hours, and how a single decision by the COMEX to hike margin requirements triggered a forced selling avalanche that exposed the fragility of leveraged markets. Because to understand what really happened, we need to separate price from value and volatility from fundamentals. And we need to talk honestly about leverage, margin, and power in modern commodity markets. First, let's get something clear. Silver did not crash because industrial demand vanished. It did not crash because investors suddenly stopped believing in precious metals. And it did not crash because inflation magically disappeared. What actually happened was mechanical, technical, and systemic. Silver futures traders, especially in the United States, often trade with heavy leverage, meaning they control massive positions with relatively small amounts of capital. And that leverage works beautifully when prices move in your favor, but it becomes deadly when margin requirements change. COMEX, the primary futures exchange for silver, requires traders to maintain a minimum amount of capital, called margin, to hold their positions. And when volatility increases, the exchange can raise margin requirements without warning, which is exactly what happened here. In the middle of heightened volatility and aggressive price movement, COMEX sharply increased margin requirements, and that single move instantly changed the math for tens of thousands of traders, positions that were perfectly healthy. Hours earlier suddenly became undermargined. Margin calls went out across the system, and traders were given only two options: add more capital immediately or get liquidated. And most traders couldn't add capital fast enough, not at that scale, not overnight, not while prices were already falling. So forced liquidation began. Contracts were dumped into the market, not because traders wanted to sell, but because they had no choice. And once forced selling begins in a leveraged market, it feeds on itself. Lower prices trigger more margin calls. More margin calls trigger more selling. More selling pushes prices even lower. And suddenly, what started as a technical adjustment becomes a cascading crash. This is why silver fell so violently from the $88 area to the mid-70s. Not gradually, not rationally, but explosively. And here's the part that most mainstream coverage refuses to talk about. This was not a free market discovery process. It was a liquidity event engineered by rule changes. And history shows this pattern again and again in commodities. When exchanges raise margins during volatility, they disproportionately hurt smaller traders and speculators, while large institutions with deep pockets survive and often benefit because they can meet margin calls instantly or even step in as buyers. Once forced selling exhausts itself, this is why so many traders woke up to find their accounts wiped out, why more than 41,000 positions were liquidated in a single night, and why so many retail and mid-sized traders felt blindsided. They weren't necessarily wrong about silver's long-term direction, but in leveraged markets, being early or undercapitalized is the same as being wrong, and this is a brutal lesson. Wall Street has taught for decades, leverage doesn't forgive timing errors, and it doesn't forgive rule changes, especially when those rules are controlled by centralized exchanges. Now, let's talk about the psychological impact, because markets are not just charts and numbers. They are human behavior, amplified by algorithms. Once traders saw silver breaking key support levels, panic accelerated, stop-loss orders were triggered. Algorithmic trading systems flipped from long to short, and momentum traders piled on, turning what began as forced liquidation into a full-blown momentum crash. And this is where perception diverged from reality. Social media filled with claims that silver was dead, that the bull market was over, that inflation trades had failed, but none of that aligned with the underlying data. Industrial demand for silver remained strong. Green energy and solar demand did not disappear. Physical silver premiums stayed elevated, and central bank policy had not suddenly become deflationary. The price collapse was a futures market event, not a fundamental collapse. And this distinction matters deeply because futures prices can move violently on leverage and margin mechanics, while physical markets move far more slowly. And historically, these moments of extreme divergence have often marked inflection points, not endings. Now, from a U.S. market perspective, this event should raise serious questions about risk management, transparency, and fairness, because margin hikes are often justified as stability measures. but their real-world effect is selective survival. They remove weaker hands, reduce open interest, and reset positioning at lower prices, which often benefits larger players who can weather volatility. And this isn't conspiracy theory, it's structural reality. Exchanges exist to manage risk for the system, not to protect individual traders. And when volatility spikes, their priority is to reduce exposure fast, even if it means wiping out thousands of participants. This is why professional traders always warn that leverage is not a strategy. It's an accelerant. And why smart money often waits for liquidation events before entering positions, because forced selling creates mispricing, and mispricing creates opportunity. So what does this mean going forward? It means that silver's crash was not a verdict on silver's value. It was a stress test of the leveraged futures market. It means that many traders were not wrong. They were simply over-leveraged in a system that can change rules instantly. And it means that volatility is not over, because once leverage is flushed out, markets often stabilize and rebuild, sometimes quietly, sometimes violently, but always with fewer participants and different positioning. For long-term investors, especially in the United States, this moment highlights the difference between owning an asset and renting exposure through leverage. Physical silver holders were not liquidated overnight. Unleveraged investors were not forced to sell. Only those playing the margin game paid the price. And that lesson is as old as markets themselves. When leverage meets rule changes, leverage loses every time. And this is why the silver crash of this cycle will likely be remembered not as the end of a bull market, but as a reminder of how fragile modern financial markets really are, how quickly paper prices can disconnect from physical reality, and how power in markets often lies not with supply and demand, but with those who control the plumbing, the margins, the rules, and the timing. Because in the end, silver didn't collapse, the leveraged positions did. And the question now isn't whether silver is finished. The real question is who survived, who learned, and who will be positioned when the dust settles. Because markets always move in cycles. Fear always follows leverage, and forced liquidation always creates the next opportunity for those who understand what really happened behind the scenes. If you found this breakdown valuable, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss our next deep dive into what's really happening behind the markets.